The Federal Reserve has released the results of its 2026 Dodd-Frank Act stress test. This annual exercise subjected 32 of the largest U.S. financial institutions to a severely adverse hypothetical economic scenario to measure their structural resilience. This proportional block diagram visualizes the simulated damage, a staggering $708 billion in total loan losses. Inside that figure, we find roughly $200 billion in credit card losses, $160 billion in commercial loans, and $75 billion draining from commercial real estate. Yet, despite absorbing nearly $750 billion in loan losses, the aggregate Common Equity Tier 1 capital ratio across these 32 banks dropped a mere 1.6 percentage points, landing at a minimum of 11.2%. The mathematical anomaly is clear. The banking sector absorbed significantly higher projected loan losses than it did in the previous year, but experienced a substantially smaller decline in aggregate capital. A 1.6 percentage point aggregate decline is a statistical outlier when viewed against recent test cycles. This bar chart tracks the maximum decline in CET1 ratios over 7 stress test cycles. Notice the stark variance. In the previous cycle, the test triggered a 2.5 percentage point drop. In 2026, the drop shrinks to 1.6. This unusually low capital depletion occurred even though the Federal Reserve's counter-cyclical model intentionally subjected the banks to worsening macroeconomic variables compared to last year. Raw aggregate loss numbers fail to capture the mechanics of systemic risk. To locate the variables that shielded the banks in 2026, we must tear open the balance sheet model and isolate the competing forces at play. The Federal Reserve applies specific macroeconomic shocks to test asset quality. The 2026 severely adverse scenario simulated a U.S. unemployment rate spiking to 10%, alongside a 30% house price collapse. Most aggressively, it modeled a 39% plunge in commercial real estate prices, a noticeably steeper drop than 2025. Severe environmental shocks collided with a 10% baseline growth in actual loan balances throughout 2025. More loans sitting in a harsher economic environment mechanically generated higher year-over-year loan loss provisions. The capital base faced a secondary drag, a reduction in projected unrealized gains on available-for-sale, or AFS, securities. Under U.S. accounting rules, fluctuations in the fair value of these AFS portfolios directly impact the regulatory capital of certain large banks through accumulated other comprehensive income. Heavy loan loss provisions compounding with AFS valuation drags create intense downward pressure. In a vacuum, these two vectors should have aggressively depleted CET1 capital ratios across the board. The offset lies in a counterintuitive variable hidden within the scenario design: the path of rates. Looking at the 10-year Treasury row, the 2026 model projected a smaller decline in interest rates, dropping 1.8 percentage points, compared to 3.3 the year before. By keeping simulated rates elevated, the model commanded banks to generate higher net interest income. This mathematical surge in projected yield was amplified by the fact that the participating banks entered the test with exceptionally strong recent financial performance. While loan losses pulled capital downward, the net interest income generated by those same loan portfolios aggressively pushed capital back up. The scenario inadvertently constructed a massive structural revenue engine. The elevated rate environment refilled the bank's capital buckets faster than the modeled real estate and credit card shocks could drain them. This chart decomposes the changes. Severe loan loss provisions drag the capital ratio down 0.2 of a point. Unrealized AFS gains pull it down another 0.2. Then, projected net interest income generates a massive half-point positive counterweight. That half-point surge in revenue completely neutralizes the increased loan losses, resulting mathematically in the unexpectedly narrow 1.6 percentage point aggregate decline. In stress modeling, a high-rate environment proves that a bank's capacity for continuous revenue generation is an equally powerful defense mechanism as its baseline asset quality. Understanding why the capital dropped is only half the equation. The absolute capital levels maintained throughout the test dictate the actual safety of the system. This step chart maps the precise trajectory of the aggregate Common Equity Tier 1 capital ratio. From an actual baseline of 12.8% in the fourth quarter of 2025, the sector falls to its stressed minimum of 11.2%. It then rebounds to 12.7% by early 2028. Notice the margin between that 11.2% trough and the strict 4.5% regulatory minimum floor. Because the capital floor held with immense room to spare, the data empirically confirms the capacity of these banks to continue lending to households and businesses straight through a severe recession. The final grade is decisive. All 32 participating large banks successfully remained above their individual minimum capital requirements. As a direct result, the Federal Reserve Board has established its near-term regulatory posture. Current large bank capital requirements in place through 2027. This regulatory pause provides the Federal Reserve time to integrate extensive public feedback, specifically targeting adjustments to reduce the year-over-year volatility of the models determining stress capital buffer requirements. A $708 billion simulated loss would cripple a weakly capitalized system. Here, it was actively absorbed and neutralized by an aggressively modeled net interest income engine. The 2026 results prove the complex, interconnected reality of bank balance sheets. Systemic resilience is dictated not by the sheer magnitude of the economic shocks, but by the precise macroeconomic environment in which those shocks occur.